Your inventory par stock, sometimes called your high and low points, has to do with how fast the items move, how long it takes to get more, how much money you want to have tied up in inventory, things like that, as we discussed on an earlier slide. So let's do a little math here. If you get twice a week deliveries and you use 10 cases of product a week, what would be your high and low points for ordering? 10 would be your high. If you use 10 a week and you get 2 orders a week, you wouldn't want to order to any more than 10 cases. And if you had 5, you'd want if you have 5, then you would be okay, right? You got enough to last you for the rest of the week. But if you're below 5, then you need to order some. So you always want to bring up to 10. So if you had 8 cases on hand, you would order 2. If you had 3 cases on hand, you would order 7. You manage to store them, and you just received 6 cases of sugar packets, each of which has 8 boxes in it, and each of those boxes contains 200 sugar packets. If you use 50 sugar packets every day on each of the 30 tables, how long will your supply last? So you just got 6 cases, each one has 8 boxes, each box has 200 sugar packets, and for use you use 50 sugar packets every day on each of your 30 tables. So 200 sugar packets per box times 8 boxes times 6 cases means you got 9,600 sugar packets received. You use 50 sugar packets per day times 30 tables, or 50. $9,600 divided by 1,500 equals 6.4 days is how long that sugar will last you. Some good ways to control theft: electronic surveillance to monitor the employees. Make sure the parking arrangements are not too close to the back door of the operation, otherwise what happens? People run out and throw stuff in their trunk, come back to work, repeat that several times, and you've lost a good chunk of money. Deal aggressively with anybody caught in the act of theft. Any amount. I once gave a lady who was a saint of a lady who went to church every day, took some Jello, I think a serving or two of Jello, to her sick friend, and I gave her 3 days suspension because theft is theft. Am I going to say, well, one Jello's okay, but two's not, or Jello's okay, but chicken's not? So, so I guess that was mean, but hey, theft is theft. I think 3 years later, when I left there, I expunged her record. Alcoholic beverages are more subject to theft, therefore having a lockable cage or storage cabinet would be a deterrent. Before you order equipment for your new kitchen, a few examples of what you should know are: how much money do you have? How fancy equipment can you afford? Your available space. What kind of space do you have to fit this equipment in? What utilities are available in your area? In some areas it's better, more accessible to have gas, and some electric, so make sure you know that. And what's the most critical thing before you design your before you order your equipment is to know the menu, because otherwise, no matter how much money you have, no matter how much space, if you don't know what the menu is, you end up with the wrong equipment. Reason for knowing your menu up front is the menu tells you the decor needed for the front of the house. It also tells you the type of service you'll be providing. Not on the test, but I think interesting. What percentage of sales goes to the bottom line for profit for a restaurant? The restaurant doctor, Bill Marvin, says, for as long as I can remember, the median pre-tax, before tax, profit for a typical full-service restaurant has been 3.5% to 4%. After tax, that would be 3 to 3.5%. So that's it. If you think a restaurant's a killer way to make money, it's not. Yeah, it can be, but in most cases it's not. That's why they go out of business, because even if they're doing it right, if if you buy $100 meal, if they made $3.50 to $4 out of that $100, they are doing well. What are some acceptable ballpark numbers for your costs? 30 to 32% is considered to be an acceptable food cost by percentage of the sales. So if you sell an item for $1, you should have spent 30 to 32 cents on the food cost. Some places, if you charge $14 for a milkshake, like they do at the restaurants in Las Vegas here lately, then you're going to have about a 4% food cost or 2%. But in general, on average, 30 to 32% works. 40% is considered to be an acceptable labor cost. Again, it depends on what kind of a restaurant you have. If it's a buffet restaurant, obviously it would be less, but 40% is just a good ballpark number in general. 8 to 10% is considered to be an acceptable operating cost, so that would be all of your other lights and repairs and things like that. And as I said before, 4 to 5% is considered to be an acceptable profit for a freestanding restaurant that pays for its own rent and utilities. Let's do a little financial terminology. This is the key to making a living in the food business, restaurants, or whatever. You need to know how to do this. You can't just cook. You need to know how to do the finances. So, what's an income statement? Income statement subtracts expenses from revenues to arrive at net income. So the income is how much money did you take in? $1,000. How much money did you spend? $500. Your net income is $500. That's called an income statement. Break even is when you've covered your fixed costs. We'll cover fixed costs in a bit. But your fixed costs, let's say your rent, that would be a fixed cost. So you didn't make any money in your restaurant until you paid the rent, right? So that's called break even. When you've covered your fixed costs or overhead, so that from this point on you can make a profit. What's the food cost? Food cost is your beginning inventory plus purchases minus your ending inventory. So you started off with $100, you bought $50, and at the end you had $20. $100 plus 50 is 150. At the end you had 20. So 150 minus 20 is 130. That would be your food cost. And we'll do that math later, but just to give you a sense of it. So the beginning inventory, what you had in the storeroom to start with, plus whatever you purchased, minus what's in the storeroom at the end. And finally, what's your food cost percentage? That's your food cost divided by sales, the cost of your food divided by how much your sales were. So let's practice some of that. What's a balance sheet? Balance means these the two sides have to balance. So that means your assets must equal liabilities plus owner's equity. So think of it as your house. The house is your asset, right? So if the house is valued at 200,000, that's your asset, 200,000, right? But you don't own it outright, probably, right? So if you owe 50,000 on it, then on the one side is 200,000, the asset, the value of your house. On the other side is going to be 50,000 is a liability, you owe the bank that, and 150,000 would be your owner's equity, how much you own of it. That's called a balance sheet. A non-variable cost that is independent of production and sales levels is known as the fixed cost. Non-variable means it doesn't change if you got 10 customers or 200 customers. It's independent of production and sales levels. That's known as the fixed cost. Combination of fixed and variable costs are known as mixed costs. So the fixed cost would be like the rent, the variable cost would be like the food. Combination of the rent and the food, that would be called mixed costs. Fixed costs are costs that don't vary if you have more or less customers, such as rent, property tax, insurance, equipment, or interest expense. Sometimes rent can be related to your customer levels, but normally it's not. So those are fixed, means they don't change. If you got 10 customers or 1,000 customers, or you're closed and on vacation for the month, you still have to pay the rent, you still have to pay the property tax, etc. So those are fixed costs, they don't change. As sales increases, the fixed cost per person decrease. As sales increase, the fixed cost per person decreases. Why would that be? Because you have more customers to share those fixed costs. So if you have one customer and it costs you $1,000 a month for rent, the average cost per customer is $1,000, right? If you got 1,000 customers, the average cost per customer for your rent will be $1. So as sales increase, the fixed cost per person decrease. When variable costs are subtracted from sales, we get the contribution margin. In other words, if you sold something for $10, but it cost you $8 to make it, your contribution margin is 2. That's the only part that does you any good. The part that you use to make the product doesn't do you any good. Okay, so the variable cost subtracted from sales is contribution margin. The ultimate goal of effective menu planning is to increase the contribution margin of each menu item to make them more productive towards your bottom line. We use that money, the contribution margin, to pay the fixed costs and then the profit. So a menu item with a high contribution margin is giving you a lot of money that you can use to pay off your rent and other things and then give you some profit. If a restaurant doesn't have enough contribution margin on the menu, that's called a restaurant that used to be there. So sales minus food and beverage costs equals the contribution margin. The contribution margin divided by sales equals the contribution margin percentage. If the contribution margin is too low and the item is not that popular, what might you do? Take it off the menu, but then you get some people that are upset. Hey, I drove 20 miles to come and get that item and you took it off the menu. Or you can make it a chef special. Oh, ma'am, we had to take that off the menu because nobody was really ordering it, but we know you like it, so if you'll come in on Thursdays, the chef's going to make that for you. If the item is very popular but the contribution margin is too low, then more likely to raise the price because obviously it's a highly successful product, and so people probably would not mind paying more money, or might not notice even they like it so much. So if it's not that popular, you might want to take it off the menu. You might want to make it a chef special. If it is very popular, then you're probably going to increase the price. A banquet hall would have a higher contribution margin than a regular restaurant because the costs are spread over more customers. You know when you wake up in the morning you're going to have 400 people coming for lunch at the banquet hall. You buy food for 400 people, you staff for 400 people, you prepare food for 400 people. The restaurant, you have to assume you're going to be busy, otherwise you'll get nailed if you are busy if you don't plan on it. So there you got to make enough food and you have no idea how many people are coming in. You have the historical perspective, but maybe there's a hailstorm today, nobody shows up. Whereas with the banquet, they paid. You can staff more appropriately because you know how many guests to expect. You can purchase exactly the quantities you need for the size of the group. Thus you have less inventory and less leftovers. So your contribution margin will be higher for a banquet hall.